Saturday, August 12th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to look at the bond market. I think the bond markets are flashing warning signs again. And why do I say again? Well, because I've been talking about it for the last couple of months or so. I also warned last year, back in July and August, about the UK sovereign debt market, or the gilt market, and we did get a major crisis towards the end of September, beginning of October. And there's an old saying in the markets that whatever happens in the UK happens in the US a year later in terms of crisis. And it's interesting that I think that could be going on again. Before we start, though, I'd just like to show you who's here. He wanted to say hello to everyone. Rudy, say hello, Rudy. We've been out for a walk already. It's quite early, and it's going to be a beautiful day. I'm not playing golf today. I'm going to play tomorrow morning. I'll be doing some work in the garden. So anyway, I'm going to put Rudy down now, and we're going to look at more serious things. Okay, Rudy, good boy. So some of you might be saying, well, I don't have any bonds. It doesn't really matter to me. Well, bonds are the foundation of the financial system, especially a fiat currency financial system. And you just have to look at John Exter's inverted pyramid, where he's got gold, of course, at the base of the inverted pyramid, and you can add silver to it as well. But then you have paper money, which is the cash, and then you have government bonds and treasury bills, and they're supposed to be at the base. And if that base is cracking, that's not a good thing. And I said earlier that I was worried, or I warned last year, back in July, August, and September, about a possible crisis in the UK. How did I guess that there would be a crisis? It wasn't a guess. It was just looking at the technicals, and specifically of bond yields, because I worked in the bond market for over 20 years. And I did a lot of not just fundamental analysis about the economy, inflation, and risk, government spending, and all those things, but also technical analysis of the charts. And you can do the same thing for bond yields. And for those of you who don't know, bond yields are, of course, just the relationship between the coupon that the bond pays and the price. So let's say a government issues a bond, and a bond is basically a loan. And this is why this is so important, because banks, they have a whole load of bonds on their balance sheets. The biggest ones, of course, are the central banks. The Federal Reserve is up to here in bonds on their balance sheets. But when governments and other institutions borrow money and issue a bond, let's say they pay 5%, they issue it at par. But if the market rate thereafter starts going higher, that bond is going to lose value in price. So the price will go to 95, and the yield will go up above 5%. And that's why when bond yields go up, it means that existing bonds that have been already issued, they go down in value, because they have to match the market rate to make it more attractive for in the secondary market. And that's where the whole problem lies. And I'm seeing the same thing now, not just in the UK. We're seeing the 2-year, as you can see here, gilt yield, and also the 10-year gilt yield rise back up. We've broken above the levels from last year when we had the crisis. And in the last few weeks in the UK, there's been a bit of a respite yields came back down a little bit, but we just retested the high from last year, as you can see here in the 2-year, and now it's going back up again. But the same thing now is happening to the US. As you can see here, the 10-year yield is starting to break out. We approached 420 late yesterday. I think we closed just around 4.18. So the highest level we've seen since the 2020 crisis, the great crash of March 2020, where everything collapsed. Except bonds, actually. They ran to bonds and yields went down, but it was very volatile. I remember a few years ago in March 2020 when you would see Treasury yields go from 0.3, which was near the low, to 1.3 in a matter of days. So there was mayhem in the markets. And the level that we need to watch now, intraday high for the 10-year is 433. I think it will probably be tested next week. So why are bonds so important? Well, as I said, they make up the base of the whole fiat currency financial system. And as you can see, there's a lot of other assets above, especially derivatives. That's another thing that will probably be a huge problem. It was a huge problem last year when we had the UK gilt market crash and the currency crash. We saw that a lot of defined benefit private pensions were doing something called liability or LDI, I forgot the exact name, and they're using gilts and futures or derivatives to enhance their returns, because for the last prior to last year, rates and returns were very low, so they had to search for yields. So there's always something that will pop up in the derivatives market that we might not even know about. And the derivatives market, and I also work closely in the exchange traded derivatives market, where they trade things on an exchange, and there is a record of the amount that's trading there provided by the regulators like the CFTC and others in Europe. But the biggest derivatives market is the over-the-counter derivative, which basically means that you call a bank, one of the major banks, and you say, I want to bet on this. And they will write you a contract. It's all the time. It's not usually, but it's always highly leveraged. And what does that mean? Well, I'll call Goldman Sachs, let's say, and say, I want to bet that the pound is going to drop to 1 versus the dollar, and I want to make a 10 billion pound bet. And let's say I have a good bank balance, but they'll say, okay, we'll do that for you. It's for 6 months, and you have to put 10 million pounds down as a margin, and you're going to be controlling a 10 billion bet. So that's how it works. So the biggest derivatives, because it's a bet on underlying assets, so you have interest rate derivatives, which are on bonds, of course. You have stock market derivatives, the index, stock market index like the S&P, the NASDAQ, and others abroad. And you have commodity derivatives, of course. But the biggest derivative mountain out there are bonds and interest rates. So you can bet when the bond market is all over the place like it has been now, and where you have the danger that yields could spike very high and very quickly, and that happened in March 2020. It could trigger loads of accidents in the derivatives market. And the example I gave you of my 10 billion pound bet on the British pound, the 10 billion is called a notional amount. And I recommend, of course, The Big Short. It talks all about derivatives and what happened in 08 And it was partly because of derivatives that everything imploded on Wall Street, and they had to bail out Wall Street. It wasn't the economy that was going bad. It was Wall Street that was collapsing. And I'm afraid that now we're going to have governments collapsing or bond markets collapsing. And I'm going to come to an interesting opinion piece in the FT that I read this morning. But back to the derivatives. So the notional amount, people speculate how much the global or the total amount of notional derivatives, especially OTC, is. There's talk that it's 1,000 trillion. It was 1,000 trillion or a quadrillion back before the '08 crisis. And after that, there was a change in the accounting that was devised by, guess who? The Bank for International Settlements, to make it look smaller. But it's impossible really to know the notional amount, but I would bet that it's over a quadrillion. It could be in the 2 quadrillion or whatever, you know, and the GDP of the world is just over 100 trillion. And there's, I think, in the whole world, there's over 300 trillion in debt. So it's really crazy. And I think the bonds and interest rates derivatives make up over 2/3 of all derivatives, maybe more, maybe a little less, but it's a significant proportion. It's the biggest proportion, and that's why, we could see something like develop in the next few weeks. And we are approaching, of course, a period of the year that for some reason always brings out some major crises, just like it did last year. And it always seems to be around the autumn or fall equinox for some reason. If you look at last year, it was, I think the British pound dropped almost 1-to-1. It was on the weekend of the fall equinox or autumn equinox. Back in 1992, we had the ERM sterling crisis. It was around the same time. The crash of 1929, around the same time. For some reason, it always seems to be the way. Am I saying that something's going to happen? Well, I would say that the way the bond market is reacting is not a good sign. And even if you don't have bonds in your portfolio, or if you're not interested in bonds, you should be aware that bonds are very important. It could affect the whole financial system. So how do I protect myself? Well, for those of you who have been listening to my videos for years, you already probably know, but for those of you who are watching me for the first time, there's only one way, and it's the hint is at the bottom of John Exter's inverted pyramid.
With rising inflation, bank failures, and massive layoffs across multiple sectors, the future of the economy remains uncertain. It's no wonder the central banks have been getting prepared by stockpiling gold. At ITM Trading, we have spent over 27 years building a team of seasoned researchers and analysts who can help you prepare for any financial crisis. Our experts are ready to provide you with proven strategies to safeguard your wealth and assets in the event of an economic downturn or currency reset, which is frankly inevitable. Don't wait until it's too late. Schedule your free gold and silver strategy call by clicking on the link in the description below.
It's gold, physical gold and silver outside the system. Why outside the system? Well, because the banking sector, the financial sector, the governments, treasuries, their balance sheets are all loaded up with bonds. And if bonds continue to drop in price, they will be in trouble. Not just the valuations of their portfolios, but their solvency. So yeah, there's only one way really to be immune or have some insurance outside the system, and it's something that you can usually hold, and that has been a store of wealth and value with no counterparty risk for thousands of years. So that's how I see things. I think the move in the bond market this past week is very important, and it should be worrying the Federal Reserve and other central banks. So now I wanted to turn to the FT. I subscribe to the FT, of course. I think the FT is a globalist central banking mouthpiece, and I've spoken about how they wrote an editorial back in '04 saying that gold was rubbish, that it was gone, no one should really hold gold, that it was irrational. So why am I going to the FT now? Well, there's that saying that you need to keep your enemies closer than your friends, right? So there's an editorial that came out this morning from someone called John Plender in the FT. And he says, bonds are no longer the safe option. In 2023, US equities have wiped the floor relative to the government IOUs. And he goes on to say that equities, of course, there's very few companies that have driven that equity outperformance, like companies involved with artificial intelligence, which he thinks is a bubble. And he could be right, but I'm going to put a link to this editorial below in the description. You don't have to be a subscriber. I'll put it in a link where you can go. It's under archive.ph and read the whole thing. But what made me really raise my interest was what he said here, and I've highlighted it. It is central banks, however, that are suffering the biggest balance sheet damage due to rising bond yields as a result of their asset purchasing programs. On March 31st, for example, the mark-to-market losses on the Federal Reserve's securities holdings stood at $911 billion. That is nearly 22 times its mere $42 billion capital. How, you might think, can the dollar remain the world's preeminent reserve currency if it is backed by a hopelessly insolvent central bank? The immediate answer is that central banks' most valuable asset is not on the balance sheet, seigniorage, or the profit on manufacturing money. In other words, central banks can print their way out of trouble. But here comes the kicker. And the fact that this guy mentioned this. So here you go. But only up to a point. As the Germans learned during the Weimar Republic, markets may conclude that the central bank emperor has no clothes. So there you go. I thought that was explosive. What does that mean for those of you who have not heard of the Weimar Republic and what happened to Germany? Well, the central bank in Germany, the Reichsbank, had a lot of debt, very much like today. And they started printing money out of thin air, like we've been doing. And they couldn't stop because usually you can't stop. It wasn't just in Weimar Germany, but it was in post-revolutionary France in the 1790s with the assignats and the mandats territoriaux. It all ended in tears because once you start printing, you can't stop unless you want to allow everything to collapse. And even when everything collapses and governments go bankrupt, companies go bankrupt, you want to have some of this and also some of this, of course. So basically the FT is saying, yes, the Fed could start printing again, drive bond yields back down, but there will be a tipping point, and that is the crack up boom. That is the hyperinflation, when investors realize that the central banks will never be able to stop inflating. And that the end game, of course, will be the collapse of the currency. And that's why I've been calling for hyperinflation, because I've read the history that once you go down this path of money printing, there's no stopping unless you want to crash everything. And I don't think they want to crash everything. And I think people are starting to twig onto it. So this is what he says at the end. So I agree with him on a lot of things he said here in this editorial, but he says the US is not there yet, and that's true, but it could change very quickly. It comes like a thief in the night, hyperinflation, and there are no good alternatives to the dollar and US Treasuries. Well, I guess he hasn't heard about gold. It's not surprising though. The FT is not going to admit that, because they are a mouthpiece, I would say, for the central banks, even though this guy here is saying, look, be careful. You're getting to a point where people are going to realize you're never going to stop inflating. So that's where I see things. And with that, I'm going to wish you all a very good weekend. Take care. Bye.